In May 2026, the SEC proposed amendments to the registered offering process that are intended to facilitate capital formation in the public securities markets. This video will highlight 5 proposed changes that are key for smaller public companies and their investors. First, the proposal would expand issuer eligibility to use the short form registration statement on Form S-3 by removing the 1-year seasoning requirement, so issuers would be eligible to use Form S-3 immediately after becoming an Exchange Act reporting company, and eliminating Form S-3 transaction requirements. So an issuer that satisfies Form S-3's registrant requirements, including being current and timely in Exchange Act reporting, would be eligible to use Form S-3 to register an unlimited amount of securities regardless of the issuer's public float. Second, the proposal would eliminate well-known seasoned issuer definition for domestic issuers and replace it with 2 new categories of issuers. The first category, eligible listed issuers, would include issuers that meet the proposed Form S-3 registrant requirements and have a class of common equity securities listed on a national securities exchange. And the second category, seasoned eligible listed issuers, would include issuers that meet the eligible listed issuers requirements and have been subject to the Exchange Act reporting requirements for at least 12 calendar months. Eligible listed issuers would have access to all of the registration and communication benefits that are currently available to well-known seasoned issuers, except the ability to file automatically effective shelf registration statements. That benefit would be reserved only for seasoned eligible listed issuers. Third, the proposal would expand an issuer's ability to incorporate by reference information from historical or future SEC filings into a registration statement on Form S-1. Fourth, the proposal would expand the preemption of state securities law registration and qualification requirements to any registered offering. States would, however, retain investor protection authorities. Finally, the proposal would eliminate certain income-related conditions in the rules that govern when an issuer must include new, audited financial statements in a registration statement or proxy statement. The extended grace periods would allow issuers to align the timing of their audited financial statements with their annual report deadlines, simplifying compliance and reducing burdens on issuers. This video is intended to provide only a high-level summary of the registered offering reform proposed in release. As always, we'd encourage you to take a look at the fact sheet and the full proposing release for more information. To learn about how you can comment on the proposed rules, check out our video and other resources at sec.gov.